Welcome, everyone. This is kind of a special event today because usually, well, first of all, we do events in Spanish with a streaming thing, but this was kind of special. And well, I'm going to introduce you very, very briefly, but actually, I think everyone who's sitting in this room knows perfectly who you are, Professor. But still, we're going to have a chat with Professor Penman. Actually, he's a George O. May Professor Emeritus at Columbia Business School, and he's author of one of the greatest accounting books for value investors, which is Accounting for Value. And he's now also the co-author, along with Peter Pope, of a new book, which is called Financial Statement Analysis for Value Investing. And this is what we're going to speak about today, isn't it, Professor Pope?
Yes.
Yep. So the floor is yours.
Okay. Well, thank you very much.
Thank you.
I'm glad to hear that someone reads the books, and I hope you get something out of them. I must say, as we said before, the books are not they're not easy, okay, because there's different ways of looking at things, which is what I'm going to talk about today. So it's easy to be scared off and say, well, I'm not going to work that hard at it, okay. But people who do work hard at the books, the light goes on. I think they find them very, very rewarding. This book has many of the themes in accounting for value, as well as other themes, but it's just flushed out more, okay. The idea of accounting for value is sort of introduce some ideas, okay. And ideas, of course, are most important things. If you read Benjamin Graham's Intelligent Investor, there's hardly a number in it. It's about how to think about it. You read Warren Buffett, it's good thinking, okay. And I think that's at the heart of it. Now, the extent you can get that into good thinking, into practical investment, equity investment management, all the better. And that's what this book does. I think I'm going to talk for 30 minutes, and then we'll have some Q&A. I hope there's enough in my presentation to provoke those questions, because there are some things that maybe you have heard for the first time, they are a little provocative, okay? I don't like to lecture, although if you let me go, I will. I like to be conversational.
So yeah, if anyone wants to, let's say, interrupt, it's going to be more than fine. Let's see how it goes.
Let's qualify that. If you
exactly.
Want to interrupt to actually, if you want to interrupt to actually present your point of view, okay, leave that until after the Q&A, okay. But please do, so we have a good discussion.
Cool. I think there's something going on with your mic. Just let me have a look. You've got, okay. There's maybe, let me, sorry, beg your pardon.
There you go.
I think this is, yeah. Now I think it should be working. Okay, let's leave this.
We've got plenty of cord here, so
okay.
Let's put it over here, and just watch out when I stand up.
Much better now. Whoop.
Okay. So another valuation book. Do we need another one? The world's got too many of them, right? So the onus is on me to tell you why I think it's worthwhile picking this one up. Okay, what's different? There's also fairly current now the idea that value investing doesn't work. Okay, the value investors have had a hard time these last several years, and so value investing doesn't. Valuation models don't work. So let's move on to other things. Let's do some cheap investing with multiples. Let's get into zero betas. Let's get into factor investing. Well, the book is actually fairly quick to pounce on some of these alternatives. Of actually, this is what the problems you're going to run into if you get into these alternatives. But it's a competition against these alternatives. Value investing doesn't work. Well, it requires us to actually think about how do you think about value investing that will work. And this is what this is about: active value investing. That is, and again, I think all in this room understand that it's basically vesting from understanding the business getting some quantification into that, and then understanding whether it's worth buying or selling. Okay, as simple as that. It's trading at $25. Do I want to buy it or do I not want to buy it? And how to think about that. And what I'm going to do is to just run through some themes in the book that hopefully will help you understand what the thinking is in the book. There's going to be some seemingly outrageous statements here, okay? You don't want a valuation model. Pretend you can get value from a valuation model, okay? You don't really need to know the intrinsic value. Ooh, that was a bit...
That's a bold statement, isn't it?
I heard some eyebrows being, I saw some eyebrows being raised here. Oh, I've got to explain. Okay. Now, but by the way, we're not talking about simple value investing. Value investing has got the, it's been used to indicate, I'm just trading on high PE ratio, low PE ratios or low price to book ratios. And that's value investing. Okay. That's not value investing. That's trading on multiples. So I'm not talking, though I have some criticism of that type of value investing, that's not what we're talking about here, okay? We're talking about, I guess, trading on, broadly on fundamental information. Now, I'm going to go through the themes, but one thing I want to say, first of all, is value investing, there's two aspects to it. The most important aspect is really understanding the business in which you want to invest in, okay? I'm looking now at the moment, I'm looking at home builders, okay, whose prices are quite depressed, okay? They're starting to look a bit attractive. But first of all, but just by the numbers, okay? But to do that, first of all, you really got to go and understand this business, okay? You've got to understand from the demand side and the sell side. That is fundamental. Mm-hmm. This book's not about that. This book's about the second thing. Once you understand the business, how you think in terms of taking that understanding of the business to understand whether you want to buy the business. And as that business trades in dollars or in euros, you've got to have some quantification, and we're going to call that accounting, okay? And that's what it's about. Warren Buffett, he says, listen, when I buy a stock, I understand the business. And apparently he can do that in about 3 seconds, okay? But then the next morning, I sit down with my cup of coffee and I pick up the 10K, the annual report, and I eat it for breakfast. This is about the second part, okay? So I want to be clear, I'm not dealing here with the major part of value investing. That's the preamble. I'm talking about then once you've got that, I think it's a good business. Do I want to buy it when it's trading for $35? Okay, so this one's very straightforward. Price is what you pay, value is what you get. You've got to understand the difference between price and value. That's sort of the standard moniker of value investors. And that's what this is about. How do you approach that, the answer to that question? Second theme, ignore information at your peril. Now, if you want to trade on low PE ratios and just screen on low PE ratios, you've got a problem. You're only using one piece of information. Well, you can get sophisticated and actually bring in price to book ratios also. That is actually what's called value versus growth investing, where a high PE or high price to book is a value stock and a low one, low multiples are a value stock, okay? You're very much in danger of trading with someone who's really done their homework, who actually is using a wider set of information. So it's a question of how you employ that wider set of information. Here's a question for you. Not many people know this question, which seems to be a straightforward question. Does leverage increase, financing leverage, borrowing, which we know is risky, makes the equity more risky. Does it increase the PE ratio or decrease the PE ratio? Now, when I should slow show of hands here, but the answer is people say, oh, it leverage, you lever up, it increases the PE ratio. No, it decreases the PE ratio. So a firm that's more highly levered, given its business, is going to have a lower PE ratio. So if you screen on PE ratio, you're just in danger of buying leverage. And we know leverage is risky. Value investors particularly tend to shun leverage, okay? Because that's not the risk they want to take on. So that's just, now there's other reasons why you can have a low PE ratio, okay? And maybe we'll talk about that. Another mantra here is buying growth is risky, okay? Growth is earnings in the future, which a firm hasn't realized as yet, okay? So it's very simple to think that getting more earnings in the future, it is risky. If you buy a stock and you think there's a lot of more earnings in the future, there's a lot of earnings growth, that should be in the price. The expectation of earnings. But what also should be in the price is risk. That the price should be discounted because the growth is risky. And I got an example of that. And this goes to the screening on PE ratios. Here's a very simple valuation model. It's not the one to use because it only has you have to have positive earnings, and it actually only works for full payout. Okay, that's because price is just forward earnings, next year's earnings over R minus G, where R is the discount rate and G is the growth. Okay, it doesn't work because G, you can get G by just retaining and not paying dividends, but that retention may not actually create value. Okay, in academic terms, that's M&M. Okay, so this is why I have this qualification, but it's very good to demonstrate the point. So therefore, earnings over price is equal to R minus G. Now, the way we typically think about it is, I guess I don't understand that, but I will.
Sure, no problem.
You get more G, okay, you get more price. More growth in the earnings in the future, the more price. But you've got to be careful. You get more G, you might just get more R. That is, the growth is risky. That the growth goes into R, and it does, but not into the price. Okay. I remember when I first started, I taught the students a PE ratio just gets growth. There's more growth. No, that's not true. Yes, you have a firm which is a number of firms. It's in the book, which have fairly low PE ratios, and you say, okay, there's not much growth. Yes, there's growth there, but it's actually very, very risky growth. Okay, and the market discounts it. That again is an exhibit for trading on PE ratios. So the book is centered on this, very much centered on this. This is the danger of investing. I see the earnings now. I see the forward earnings. I got a good forward earnings. But what I'm doing is I'm buying growth. And the basic question in investing is whether I'm buying growth, which is gravy, which goes into the price, and gives me a higher PE ratio or lower earnings to price, or whether it's growth that's risky. That's what we've got to sort out. Okay. That puts in a nutshell. And the book takes you through how to think about that. Here are the returns to earnings to price overall. This is 1982 to 2020. These are PE ratios and price to book ratios. And it shows you, portfolio one has low PE ratios, low price to books. Portfolio has high price to books and high price earnings, or low earnings to price, low book to price, okay? And you see that actually it works on average. And that's what's very attractive, okay? That actually if you buy low price to earnings and low price to books, on average, the returns, these are US stocks, all US stocks, returns are higher. So that screen works. Man, if that is that easy, you must think there's something wrong, okay? If it's correct, it's time to leave, okay? It's time to leave. This is easy. A fifth grader can do this. All you need to do is find the price or earnings and the book value. And if you learnt division, okay, then you've got the number, you're done, okay? But there's got to be something more to this. And we understand that, yes, if you get higher returns, maybe there is, it's reward to risk, okay? And the book goes into how you analyze that. If you do this, you break this up into years where you have down markets, 2022, 2008, 2009, you really get hit. You really get hit. When growth takes a shock and you're in this strategy, you really get hit. So understanding growth and the risk to growth are the two ingredients that we have to deal with, and which the book, which is the idea that the book takes up. Okay, now these are just themes of the book, okay? And if you read the Accounting for Value book, these things turn up here. This book largely, there's more themes here, but it largely flushes it out and tells you how to handle it. Mm-hmm. Here's a valuation model. Well, we go to business school and they tell you value is the present value of the cash flows, okay? And it sort of makes sense. You invest to get cash, because if you get cash, you can go and buy, you go out and party and have good wine and so on, okay? This is what you want. It sort of makes sense from that point of view. First of all, there's a problem with equities. In contrast to a bond, it has no maturity date. The bond, you're actually under contract. You know the coupons and you know the maturity value. They're given to you, and it's just the risk of not getting those coupons and maturity values. But if equity, there's a going concern, okay, which goes on indefinitely unless you have evidence otherwise. And so what we do is we say, oh, we truncate. I can forecast cash flows for 4 years. I'll truncate and plug in a growth rate. Mm-hmm.
Yeah.
Now, fundamentalists will say that's very difficult. That's a long run. And it's cheating, really, because she says you really have to look at the long run and you pretend you can cheat and just put in a G and you're done, okay? There's also an R, which is the required return. What's that? These are the two things, R and G, that the book is basically dealing with. R, the discount rate, the cost of capital, the required return, has absorbed us in finance, in academics, for, well, you can think since Markovich, okay, 1950s. 5 Nobel Prizes for the attempt. It's a dirty little secret. We don't know how to calculate the cost of capital. And I can tell you a farmer in French factor model does not do it. So how do we do that? Well, we have to work that through. Okay. Here's some two value investors. This is the Honorable Benjamin Graham. He says, first of all, beware of valuation models. Don't use them. Okay. He says anything based on prospects of the future, which you can discount back. He calls it formulas that are higher mathematics. Well, I wouldn't call this higher mathematics, to tell you the truth, but it's a mathematical formula. How disappointed an MBA is coming into my class, and I tell him or her this, I just want the formula, Professor. I don't want to think about it. No, I can't give it to you. I like this one here. This is Charlie Munger, the late Charlie Munger, Buffett. So I'll actually read this one. Some of the worst business decisions I've ever seen are those with the future projections at that discount back. It seems like the higher mathematics with more false precision should help you, but it doesn't. The last sentence I love. They teach that in business schools because, well, they've got to do something. Anyway, so these are the sort of the standard things that we have to deal with. Okay, and this is the book takes on. To do so, and you'll be familiar with this if you've digested the Accounting for Value book. Valuation is a matter of accounting. One accounts for value. Okay, and it's a question of how you do the accounting. I'm actually, although I'm in finance and financial economics at Columbia, I'm basically an accountant. Okay, I grew up as an accountant, and bringing accounting and finance together has been very quite productive. But this is the thing. To have it, you do some accounting. If you want, you keep a book on a firm. Okay. Javier and I were talking over lunch about this. It's really impressive how bad accounting is in society. Okay, our governments, they do terrible accounting. Don't even have a balance sheet. Okay, our politicians think debt is revenue. There needs to be accounting for government, but it needs to be, in terms of doing that, think about accounting, valuation in terms of balance sheets, and the value to be added to the balance sheet, which is earnings. Because all earnings are expectation of the future of what you're going to book, and then you add them to the balance sheet, to shareholders' equity. And that tells you where the book value is going to be in the future. It's current book value plus the earnings you're going to accumulate, added to the book value, minus any dividends. Warren Buffett says, what do I think about it? I think about where the book value is going to be in 10 years, 5 years or 10 years. Because that's going to be based on the earnings that they're going to take in. Okay. And I keep a book in valuation. It's a prospective book. It's a pro forma book. Of modeling where the income statements and the balance sheets are going to be in the future once we understand the business. And of course, a distribution around there, because things can go better than you expect and things can go worse than you expect, which then gives you a handle on your fundamental risk. Okay, so let's do some accounting and think about our basic formulas of accounting. Here is the pervasive DCF calculation. My finance college at Columbia, they still teach this in the core finance course because A, they don't understand accounting, and secondly, accounting is just bookkeeping. Is cash is what you want, and actually that's true, cash is what you want, but you want accounting that tells you about what the cash is going to be. And so it's free cash flow which is the enterprise valuation minus the net debt. Okay, so the question there, we got the same question: what is R? And of course, what is G? And we know that it rides very much on your specification of the R and the G. You change R a bit and G a bit, R minus G, it throws that value all over the place. Okay. And you don't know what they are, particularly the G, it's just speculation. And here's one of the other motives of value investors. When you do valuation, to challenge the price, the speculative price, do not build speculation into your method, okay? And that puts it right in. But there's a further problem. There's an accounting problem. And the accounting problem is, what's free cash flow? Free cash flow is cash from operations minus cash investment, okay? If you're generating cash and you invest back in the business, the free cash flow is the difference. Why is it called free cash flow? Because it's free cash is now free. You don't need in the business. It's free to distribute to your debt holders and your equity holders. Okay. Now we're going to look at Netflix a little closer. Here's Netflix for these years here. Okay. It's negative. First class, the students. Listen. We're standing at the beginning of 2017 here. Psst, inside information. I'm going to tell you what the free cash flows are going to be for sure. Great. Certainty. Oh, Professor, I have a hell of a terminal value problem here. Okay. I know, for example, that prices can't be negative. But all I got, except for 1 year here, all I've got is negatives. Why? Well, you can see it. We usually think of investment as something you do to add value. Well, I know that corporate jet is a little bit doubtful, but typically that's why we invest, to add value. Free cash flow, and I call this cash accounting, okay, because it's what goes through the cash flow statement. It treats investment as a bad. Here's Netflix all this time. What's it's investing in? It's video production, it's acquisition of source materials and so on, which is all going on the balance sheet. It's bad accounting. You actually generate more free cash flow by liquidating your assets. Because why has been this so pervasive? Well, because that's what they teach in business schools, because they got to do something. I don't know. I don't think that's completely right. Okay. A little later, I'll tell you. Here's General Electric. Now, General Electric has had some negative free cash flows because cash from operation went to hell. This is back in his glory days, okay? Every year, almost every year, General Electric, GE, reported negative free cash flows because they're investing more. 1 year was different here, 2020. These are billions. So this is 14.26 billion positive free cash. Lovely. We're finally getting free cash flow. No. You can see why. It's because the investment dropped. This is the year they want to acquire Honeywell, and the European Union says, no, go back home. And they didn't make the acquisition. It's bad accounting. You can see the earnings for both these companies are increasing. Now, I'm not saying the earnings are always being perfect. There are issues with earnings, and that's the question of what's good accounting for earnings and what's bad accounting for earnings. Okay, but you see that's increasing in pace with the price. So here's the model, which I hope most of you are aware of, which is the accounting-based model. It's not based on cash flow statements. It's based on balance sheets and income statements. And it says, take the balance sheet B, which is the book value on the balance sheet, which is equal to assets minus liabilities. The accountant has done certain work in establishing some value in the balance sheet. We know typically, unless it's an investment fund and the NAV is value, that this is not necessary value, okay? But it says then what happens is to get value, you actually add the earnings that the book values are going to earn in the future, that ultimately are going to be closed back to the book value. But you got to cover your cost of capital. And so the R is in there. This is probably a better way of seeing it. It is ROE, expected ROE, 1 year ahead, 2 year ahead, relative to required return. So you see, if your required return is 10% and you forecast your ROE is only going to earn 10%, that's zero, and it's actually worth its book value. That is a theorem. That is a fundamental accounting theorem. If in fact you see a firm, if your cost of capital is 10% and you see a firm is only going to earn 10% on its book value, it's got to be worth its book value. And similarly, if you see a firm that trades below book value, but you forecast that its return on book value is going to be 12% against a 10% required return, you've got to go and buy it. Well, hold on, there is the R. I'm pretending you got the R, okay? And of course, here we got the G. So we still have the R and G problem, but we're actually putting you in now into a setting which you call accrual accounting, balance sheets and income statements. And one of the themes of the book is balance sheets and income statements work together. It's double entry accounting, and you've got to employ the properties of double entry accounting. The book comes out and says, people say, listen, intangible assets aren't in the balance sheet. Okay, I got to put them on the balance sheet. Yeah. Well, you can demonstrate very readily. Coca-Cola has a price to book ratio of 8 or 9. Okay. We know why, because it's generating a lot of earnings from its brand, but its brand is not on the balance sheet. Oh, I've got to correct that. So let's say the brand is worth, I estimate it's worth 80, but I'll mark up the balance sheet. Well, if you mark up the balance sheet, that is going to be this book value here. That's going to reduce these numbers here, and it makes no difference to the equity value. That's an accounting property that says you don't have to have a perfect balance sheet, because the income statements, there's no brand on the balance sheet, but for Coca-Cola, the value of the brand's coming through the income statement. Okay. And you can employ that property. Now, there is more of a problem when it's a startup, okay, and it's not earning us yet. Then you have a long-term problem about the return to the R&D, and so we've got to deal with that also. Okay, so this is Benjamin Graham again. Always separate what you know from valuation. Separate what you know from what you don't know. Call that speculative value. And he said, base your analysis on what you know. With a little bit of poetic license, I'm going to call it accounting value. What can I account for? Okay. And therefore, what is the? You watching my time here?
You're doing all right, Professor. Don't worry.
I'm using up my time. That's what I'm doing.
That's all right. I think everyone's enjoying, right?
Well, I won't keep you too long. Separate these two and then anchor on what you know. So the idea of the book is now see what accounting I can do to account for value, and that will tell me. Give me some. As long as it's good accounting, that'll give me something to anchor on. Then I can compare that valuation with the market's price. Okay, the speculative part of the market price, which turns out to be the speculation about growth, which turns out to be the G. Okay, so this is the formula, the model. Now we still have a model, but we're using the model very differently. Rather than pretending we put in a G and an R and get the price, we'll put in an R and we indicate how we might do that, but we won't put in any G, and the rest is speculative value. Okay, so we're separating out the speculative part of the valuation. Here's Netflix now, and I'll run through this very quickly because of our time. Here is the formula. Value equals exactly the thing with the speculative value sorted out. I do a calculation here of the accounting. I can count for book value. I can count for earnings in the near term, okay, forward earnings, and I can calculate the speculative value. What I can count for is a no growth value. So actually the speculative value is the growth that's implicit in the market price. I therefore can actually build this building block diagram. Very little book value at Netflix. There's value in what I can count for in the earnings, but the blue thing is the difference between that and the market price, which was $344 at this point in time, okay? Now I've got a different problem, different way of approaching it. Rather than saying, do I want to pay $344 for Netflix? I want to ask, do I want to pay $177 for growth? Mm-hmm. And that's, I'm not doing valuation. I'm using the valuation model to understand the market's pricing at growth, because I'm working under the mantra, beware of paying for growth because growth is risky, okay? First, I ask, what is the market ask me to pay? Now, I can go further here. This is the video, okay, where at the time here, it's in the book, I'm using the examples from the book, the speculative growth was 83.3% of the market price, okay? And that's what I want to challenge. Here's what I can account for, but that's what I have to challenge. Now, I'm going to go through this pretty quickly. Now I can go you're with me? I'm scared of the time. You guys got to go.
No, you're doing fine.
You have late dinners in Spain, don't you?
We do have late dinners. We've started like 10 minutes later. So actually you're on schedule right now. So okay. Not a problem at all.
This is in the spirit of Benjamin Graham negotiating with Mr. Market. What do you think about growth? Okay. Is the first question. I've never done a negotiations course. I negotiate with my dean occasionally about what he's going to pay me. I don't have to negotiate. I negotiate with my wife quite a bit. And one thing I understand is it's very important to understand the thinking on the other side, okay, where they're coming from. And that's the spirit. So, Mr. Market, Senor, what are you thinking? Okay. Now I can put the market price on that side, and I can take the model and invert into a growth rate. In this case, it's 4.71%. Yeah.
That's why you do this reverse calculation, but you take the EPS from the consensus from the market, because you want to understand what is the market expecting from.
No, I don't. In the book I do, because I'm just ripping off the analyst consensus forecast. But we have some doubts about analysts. No, it's probably better to be your forecast. Okay, you say, listen, I can forecast 1 year ahead. I get information of that, and that's actually the current year in progress. Okay, maybe 2 years ahead. But actually, if I can't, I just take the current earnings. Okay, so it's your input. Okay, your accounting. And the analysts sometimes, particularly on that second one ahead, they're sometimes in different states, they're a little bit too optimistic. Mm-hmm. And so this is the 9 number to challenge. And that's where it all starts. This is really the starting point. I don't do valuation. I don't believe in valuation models to get the price, but I want valuation, a good valuation model based on balance sheets and income statements, to understand the thinking of the market price. Now I've got this growth rate. This now is where my fundamental analysis starts. Now, actually, I understand that this growth rate can be decline over time. I can get a declining growth part implicit from the market price. What's the market's implicit growth rate over time? I'm going over these. This is Netflix in 2022 when we were writing the book. January, that was the price, $9.57. I looked at $3.43 here. By June, it was $1.75, down to 8% of the growth is 8% of price. The implicit growth rate was 0.84. Now, what's the average growth rate for US firms? The average growth rate for the average growth rate for US firms, is a GDP growth rate, okay? So we have Netflix. Now, at times it was being challenged. A lot of other streaming services were coming on and so on. That's very attractive. Now, I just don't say that in retrospect. Mm-hmm. But you come back and say, well, maybe this is something I should really look at. I should really look at. Even the 4.71 is a little bit higher than the nominal GDP growth rate, but it's worth it. But whatever, this is the place to start. This is where your fundamental analysis starts, okay? You don't do fundamental analysis to actually get a spreadsheet, get your sales growth into the future, and then use the formula to take the G and the R and get a value. No. And when you think about it, I'll jump over this. This is Benjamin Graham. He says, actually, I say in the book, there's no such, it's the best way to think, there's no such thing as intrinsic value. Think you can go out there and find this intrinsic value. He actually says it here. But when you think about it, the investing game is not a game against nature. It's not like there's an intrinsic value and you have to go into the dark forest and find it amongst the herbs, okay? No, it's a game against other investors. All you have to do is say, I agree with Mr. Market. I disagree. I think he's pessimistic, or I think he's optimistic. Because all you can do is buy, hold, or sell. It's a game against other investors. So this is the way to approach it. The onus is not on you to actually get a growth rate. It's not on you to get an intrinsic value. It's just to reject or accept the market's thinking. And that's where your fundamental analysis starts. I'm going to finish up. Valuation models are not for valuations. Throw them out. Yes, they don't work. They're there for understanding the pricing of the market price, and to do that, you have to do a bit of accounting. Now, the discounted cash flow model is pervasive. It's far less common on the buy side from the ones I'm interacting, but there's probably some ones I'm interacting with, but there's probably some self-selection there, okay? But it's pervasive on the sell side. Why? Because you're in a hot IPO market. You're telling the issuer, hey, now time's to go to IPO. Look at these other firms. They're getting very high multiples for their issues. It's a hot market. It's time to go. And I think we get you a very good price. And maybe that price is not value. But at least in the US, under the law, you've got to do your due diligence and show that that's value. So you want a bad valuation model. You want a discounted cash flow valuation model. Fiddle with your R and your G, you get the valuation you want. And it's very hard ex post to actually show that that's out of the bounds of the noise in the system. Okay. I'm going to finish up. I keep saying that, but I don't finish up.
It's all right.
I just want to get to the evaluation part of it. Fundamental analysis. Okay. So the task now is to understand what the market's growth path is and see whether, knowing the business, I can justify that. Now remember, it's growth in this value added earnings, okay? Residual earnings, okay? And the question what the drivers are, and this defines your fundamental analysis. First thing to do is unlever enterprise value, because leverage, we know exactly, and we know deterministically that leverage increases growth. There's another problem of buying growth. Highly levered firm will have higher implied growth from the market, okay? Because leverage buys your growth, but it's growth that's risky. So you get rid of leverage and you work on an unlevered basis or on an enterprise basis. And that, what is the number here, is the residual income from your business, your operations. Okay, I just give you two formulas. Okay, and these are formulas that always work, because they're accounting formulas, and accounting formulas always work because they're deterministic. The double entry set. Return on residual income is driven by sales, profit margins, and asset turnovers for a non-financial firm, okay? This tells you to grow, you've got to increase your sales, but that's not sufficient. You've got to have positive profit margins, but that's not sufficient. Your profit margins have to be higher than your required return relative to your asset turnover. Mm-hmm. But it gives you ingredients and tells you this is what I focus on there. Here's the market's expectation of the growth rate. Can I justify that from my understanding of the business in terms of growth in sales, profit margins, or asset turnovers? No, they've got good profit margins now. There's no way they're going to increase their profit margins that much. It's got to come from sales. Can I see the sales? And if I can't see the sales growth, not today, Mrs. Murphy, okay? And then the final formula I'm going to give you, these are all deterministic formulas. And actually in the book, there's many deterministic formulas because they're from accounting, okay? And they're always correct because of the system. Now, we haven't talked about the R, but one thing for sure, you can always put in your own R, okay, in that calculation. Well, I think I need 10% for investing in Netflix, okay? Or I need the risk-free rate plus 5% or whatever, okay? There's other ways of thinking about it the book goes into, but one thing's for sure, the R is still the most difficult part of it. But there's another way of looking at it. I can think about not what my R is, but what's my expected return from buying at the current market price, okay? We call that ER. As a formula here, it says the expected levered return is just a weighted average of your forward ROE and your growth rate, where the weighting is in book to price and 1 minus book to price. Now take it from me, that's always true, okay? And in this uncertain business, latching onto things that are always true is very helpful. Mm-hmm. Now, why is this not R? Because it's got price in here. If the price is too low, it gives you a higher expected return. Here's the G that you can come up with in your challenge with this to market. And it may be low, in which case the expected return is low, or it may be higher than the markets, in which the expected return is higher. On an unlevered basis, we have to look at the net operating assets of the business, and of course the return on net operating assets from the business. That tells you, and that's in some sense, that is the way to think about the return, expected return. What's the expected return at buying at the current price? Mm-hmm. And this doesn't depend on R, okay? So I think I'll leave it there. We can sit down, I could read chapter 8 to them. But we'll leave it there, and I'll ask you for questions, and please, any pushback.
Yeah, of course. Lots of things to digest here,
Yes,
I think. I don't know whether some of you have any questions, something you would like to ask, something you'd like to protest, as you said before.
I'd like to ask you, obviously the book is really extensive, and I haven't seen any other investment book such in deep analysis and the different areas to cover. So my question is, what would you recommend to someone that reads your book and tries to build a framework? Because even you talk in the additional materials to build your own framework. But what would you recommend to someone to build that framework following all the areas that you cover in the book? From challenging the market growth, from other, looking at the balance sheet, growth is risky, leverage is risky. What would you recommend?
Well, I'd say go ahead, okay? You can build this into a spreadsheet, though all my students do Python and everything else now, okay? Use other platforms. You can build it into a spreadsheet. And so you want the basic balance sheets and income statements in there. Maybe you want a forecast of forward earnings in there, your own forecast. And then once you've got it up there, you can start pressing buttons to get the market price. You can it'll just give you the growth rate, okay? It'll give you the declining path too by if you use the goal seek feature in Excel. My students do it. I've got a confession. I don't do it. I don't know how to work Excel. I still work on my pads, okay? I still do, with a calculator. But they do it, okay? And they can get very fancy. And they've from just taking the class with fair amount of ignorance to start with, develop it. So you can develop that. And you can get part of it automated in the sense that because a lot of it's accounting relations, you just press a button or you introduce different scenarios. Hey, what does it require? What's it, the current profit margins? What does it require in terms of sales growth? To asset turnovers are usually pretty constant. What does it require in terms of sales growth to justify the market price? And that can come out of it. So now, to have confidence in what you're doing, however, it does require some internalization of the ideas. Okay, you've got to be convinced. And that's, of course, I think that's very important, all that you have to be secure. And I think the overall purpose of the book and this approach is to make you more secure. You're following it. I'm not going to build in speculation. Okay, I'm not going to do valuation. All I'm going to do is negotiate with Mr. Market. These are very simple ideas, okay? And the mechanics can, if you get these ideas, I think that spurs you on. Now, there's a question of the accounting. There are chapters in the book that say, well, hold it, let's look at these balance sheets that IFRS prepares and US GAAP, okay? What's it? Well, there's some problems with stock options, okay? And there's some problems with this aspect and that aspect, okay? So you have to be a bit aware of that. It doesn't turn up in every case, but there's some red flags you have to look for to get your accounting ordered. Did I answer your question?
Sure.
Okay.
All right. Who would like to ask some more things?
You mentioned all the time about...
You've got a mic there.
Yes.
You
you mentioned all the time about R and G. You have a different view and a different approach of how to calculate and how to use both items just to compare with your ideas. But for me as a professional investor, for my students indeed, it's quite difficult to understand what is the real G and the real R. And I want to hear you. What is your criticism to FAM and French in the use of R? Because it's so difficult to understand the basics of the cost of the capital and how to use it properly.
That's a good question. I think we've dealt with the G aspect. There's nothing wrong in this of just you as an individual investor inserting your own hurdle rate, okay? And that you can do quite readily. To do that, I think you've got to do some risk analysis. And the basic risk analysis is to what extent, if I see sales and I'm willing to accept certain expected sales and profit margins, what's the risk to that? Okay, that actually I'm not going to get that. That's a conceptual way of looking at risk, but it doesn't give you the R. Okay, but it can give you risk classes. Okay, here's one where actually my expectation of is likely to get shot a lot. In which case, I'm going to want my R. Okay. But the basic problem here, and that has to do with the farmer and French, is that we just don't know any R. And I've come to the conclusion, and the book says, one thing about a value investor is be honest, okay? And by that, of course, I mean you have to have integrity, okay? But I mean more, be honest to yourself, okay? Be honest about what you know and what you don't know. and we don't know R. Okay. The book talks about how to finesse this in terms of looking at risk groups based on the susceptibility of sales and profit margins to being hit. I'm of the opinion that our whole pursuit of the idea that there's an R that exists out there that we have to find with Farmer and French or CAPM or anything, okay, is actually a fool's errand. Their businesses are anything but a simple lemonade stand business is very complex, particularly for international business. To actually think we can funnel all that complexity about risk down into one number, hey, it's 8.1%, it's not 8.5%, okay? And that makes a difference. I think it's a fool's errand. Mm-hmm. And we have been pursuing that with capital asset pricing models. The model's good because it makes you think about systematic risk is what you pay for, not idiosyncratic risk. So there's good thinking there. And then you forced me to talk about Farmer and French, okay? Farmer and French says, well, we find out, well, the CAPM doesn't work, okay? It doesn't really give you R's. Beta is dead. Mm-hmm. So I said, oh, well, there must be other factors I can add in, these multi-factors. And they start with 2 extra, and now they're up to six factors altogether, okay? But what do? They simply drag through the data and find out what's correlated with returns. And because Farmer is the high priest of efficient markets, it must be risk, okay? Now, scientifically, it's not the way to proceed. You just can't do data dredging to get factors. And we know it's said that now there are over 400 factors that people have found by dragging through excuse me. Oh, just came in from London. They just found another factor. Okay. So it's very unsatisfactory. But the thing is that if you take the Farmer and French model and you run it in sample, you get very good R squareds. Explains realized returns. But then you take those estimates, the sensitivity coefficients and the factor premiums, and apply it out a sample, nothing. It doesn't work in real time. So, and of course, invest has to work in real time. Mm-hmm. So that's why I say that's whole enterprise of trying to find R, the discount rate, has been a very disappointing enterprise. And I tend to think that we're not going to find it. And you and I, we have different discount rates. I can remember when in the financial crisis that November, when the whole damn thing crashed, the S&P 500 went to 667. Warren Buffett wrote a piece in the New York Times. Now's the time to buy stocks. And so I took the article into my class. Now's the time to buy stocks. Are you buying? They looked at me and said, no. Well, it turns out, Columbia's a finance school. They're looking for jobs in finance. The question whether they're going to get jobs. They're going to get jobs. They got student debt up to the roof. Okay. They're highly levered. They're running from risk, like a lot of other people. They're not buying stocks. Warren Buffett, AAA ratings, he's buying stocks. I said, Professor, are you buying stocks? I said, actually, I'm looking at some very closely. But you've got to remember, well, first of all, I don't have much debt. Actually, there's still a little bit of the mortgage on the house, but, there's a lot of value on the house too. And, I have a job. I'm not looking for a job. And, I work for Columbia University, and they're stupid enough to give me tenure. My attitude to risk is very different from yours. Yes, I think I'll get into it. Okay. I can tolerate risk. And the financial officer says that's what actually is good. The people who can take on the risk actually will go and buy the stock and provide the liquidity for those who are running. Okay. And but they're very different people. One of the problems is it tends to be the rich you can do so. The rich get richer and the poor get poorer. That's another issue. I think we know leverage. We know about leverage, and we can put firms into 10 risk groups. Okay, based on the analysis of risk in this book, the risk to value-added earnings. Okay, sales margin, and we can think about in groups. But to put a percentage number on it, 8.1 versus 8.5, is not on in my mind. That's another pretense of valuation models. There is an R that you can just plug in. You can put your own hurdle rate in though. And the student says, I'm not buying in 2008 because my hurdle rate is 35%. And we know the hurdle rate for venture capitalists is very high too. So the problem is some of this thinking gets you into a cul-de-sac, okay? There's no quantitative way out of it, okay? You can't quite get what you think you want to get. And part of that comes from the pretense of these valuation models that these things you can plug in, R's and G's. But I think we've got to be honest with ourselves. I don't know about you, but one of my great problems is self-deception. Oh, I'm a fancy professor at an Ivy League school. I'm great. Never say that. Okay. Never say that. Some of them do. Deal with self-deception. And I think a lot of, I'm starting to preach a Sunday sermon here. Please.
Stephen, just for the benefit of the audience, I think you could spend 5 minutes just discussing how far can the accounting book take you in terms of PBs and Ps. Back in 2023, you wrote a fantastic paper for the Financial Analyst Journal discussing how sorting stocks for PB together with PE, it gave you a very nice idea about risk and return and how high PB ratios are not a sign of growth, but its earnings have been realized, so ROEs are very high and so on and so forth.
Well, this gets into the accounting, and the book brings us in the whole chapter on that, actually. So I'm not going to the double screen, the value versus growth screens on price to earnings and price to book, okay? Or earnings to price and book to price, okay? But you understand that earnings to price my price over book is equal to earnings over book value. Okay, use the two. When you use the two, you're actually covering the book rate of return. Okay, and so that article says, well, what you're really buying is profitability, book rate of return. And then that leads you into the question is whether you want to buy as a value investor, whether you want to buy high book rate of returns or low book rate of returns. Well, the standard answer is value investor, we only buy profitable companies, okay, with high book rates of return. But there's an accounting problem. And this is a very common misperception that the counting rates of return, whether it be ROE or return on net operating assets or return on assets, it's not what you think it is from an economic point of view. An economic book rate of return on investment, is the earnings in the numerator over the investment to get those earnings. But what the accounting does, with respect to many investments, and more so for other modern corporation, it doesn't put the investments on the balance sheet. It charges them against the earnings in the numerator. R&D, advertising, brand building, developing supply chains, developing distribution systems, software, okay? It all gets expensed in the numerator. So it's not the book, it's not the profitability, okay? But that paper and the book has a whole chapter on this issue, says, well, there's actually some method in the madness here. Why do we actually book R&D to the income statement under US GAAP? Under IFRS, they only book research to the balance sheet. Development, once you met some hurdles and it looks like it's going to pay off, you can put on the balance sheet. Okay, why do we do it? Well, the standards say because the uncertainty of future benefits. There's much higher probability it won't pay off. And you look at the numbers, R&D is only successful about 10% of the time. Okay, more successful for large pharmaceuticals than the R&D biotech startups. Okay, so the accountant says, I won't let you put that on the balance sheet and pretend you have collateral. They pretend there's an asset. But you notice what's going on here. It's a risk. It's a risk criterion. Inventory can go on there because you can probably sell it tomorrow. And you build a plant that produces known inventory, probably can sell it. Okay, but you're doing R&D. There's no product yet. They're high probability there won't be. Okay, it's risky. You only put you on the balance sheet. So that whole treatment is actually indicative of risk. So what happens then? If the investment's successful, well, then you get the earnings, Coca-Cola's brand, okay, but you get a very high book rate of return because all the investment's been expensed. It's on a very low denominator. So a high book rate of return is for a successful company, and a low one, which is affected by this accounting, for one which is very highly risky. Amazon's a good case. For 20 years, it had a very low, it had negative ROE, okay? Why? Because you have the income statement, the investment in innovation technology. The guy's investing in all different things all the time. He's investing in drones to deliver your toothpaste through your bathroom window, okay? And that all gets expensed. Now, it turned out that actually paid off, and now they have positive book rates of return. Starbucks, way back, they had very low profitability. Why? Because all this development, these supply chains of getting this coffee up from Latin America and so on, is very expensive. It depressed the numerator. It was risk, but it actually paid off. It's 50% now, book rate of return. So employing the accounting and how it reveals risk is part of how you deal with risk in the book. Okay. So that article said, when you use earnings to book to price and earnings to price, you're really looking at earnings to book value, and that's what you're buying. You should go and look at the accounting and see if you're buying risk, okay? Because when you do that strategy, actually there's some very nice returns, some very nice historical returns. But man, do you get hit in 2008, 2022, 2017. Man, you get hit. So that's more the question of how the accounting deals with risk. And I've come to appreciation late in life. We all always thought about accounting indicating the future profits and the future cash flows, okay? But when you think about what drives accounting is two principles. I learned this from my first, we got time? Because I tend to talk too much.
Go for it. I don't think anybody is going to complain.
Please feel free to leave. My first accounting class, the professor waddles in, lights up his pipe. We all light up our cigarettes. That's how you did it in those days. And he says, listen, when you're keeping your accounts for your tennis club, you use a thing called cash accounting. Here's the cash receipts coming in. Here's the cash receipts coming out, going out. There's no balance sheet except there's a cash account. Okay. In a business, we use a thing called accrual accounting. Okay, which recognize earnings in each period different from cash flows. Over the total life of the business, the total cash flows equal the total earnings. Okay, but in any one period, the difference. And then he says, second period, second class, what is the basic accounting principle which determines the difference that drives accrual accounting? He said, here it is. And it's true as the day is, what's the saying? True as the day is clear.
It's bright. I don't know.
Clear as the day is up. There's an English expression there. Anyway, he says, we don't recognize earnings until we get a customer. That's more formally said the realization principle. You can think and price a stock based on the expectation of the customers they're going to get in the future, but the accountant says to you, I'm not going to book that until you actually get the customer. That is built into the accounting is the idea of appreciation over risk and the resolution of risk. Okay. When you get a customer, or when you actually invest in R&D and you actually develop a drug, get phase 3 approval, and you get a blockbuster, then you've got resolution of risk. Okay. And until then, it's all at risk. So that realization principle. And then he said, what we do then, we match expenses to the revenues, and that gives us the markup. And he was wrong on that, because what we do is, many investments, we mismatch. We put R&D in the income statement, and that's not expense to get the current sales, the expense to get the future sales. But in that madness, there is also a principle. It's called conservative accounting. I'm not going to put an asset on the balance sheet, pretend I have collateral. Okay. And the market does that. We know that a startup cannot get debt financing. Okay. It has to be equity finance. It's only until you get collateral that you actually can get debt financing. And so those two principles together, the realization principle and the conservative accounting for investment, they are very revealing about the risk. And you can think of accounting statements now. Yes, if you get sales now, you probably can get more sales in the future. But the evolution of the financial statement is the evolution of risk. They're making investments, some on the balance sheet, some off balance sheet. And the statements record the state of their position in risk and how that's resolved if they start getting customers and start growing customers. So that was a long answer.
That was great.
But my wise, right?
But no, the society in general, and I don't imagine Spain is any different, doesn't have a high appreciation of what accounting can tell you. Okay. Well, they don't have good accounting. As I said, the government has lousy accounting. Okay. We have lousy accounting for a lot of things. And this Trump, he complains about the trade deficit. Okay. And we've got to beat up on those Chinese. They're eating our lunch. But he doesn't recognize that that's just a flow. In fact, his flows are wrong because actually we have a big export of services, okay, to China and the rest of the world, okay? But he doesn't have a balance sheet. And it turns out if you look at the balance sheet of those, which includes the wealth of the market value of the firms who are doing business in China, it's a big balance sheet. Apple's up there, okay? Look what it's doing for America and American shareholders because Apple's in China. If you pull the balance sheet in, you say we're actually in a pretty favorable position. And what you're trying to do is destroy Apple's business, so the balance sheet goes down. It's accounting without flows accounting and doesn't have a balance sheet. And that's the core of the business, is you've got to use the balance sheets and the income statements together. That's the wonder of the double entry system, which many famous people, Schumpeter and even Goethe, has admired as one of the great inventions of mankind. But so anyway.
All right.
So actually, getting appreciation for how accounting works is very helpful. Okay, because accounting works within certain fixed system, which gives you these expressions which are always true. Okay, and anything that's always true when you're doing investing, something you can anchor on, hitch your cart to, is very, very helpful. It doesn't mean you have to be a fantastic forensic accountant or anything. You just have to really have the appreciation of the aesthetic of how it works and what you can get from it.
Do we have any more questions within the audience? All right, so thanks very much for sharing your wisdom with us. I think it's been enlightening having you here, spending your time presenting this, which I think is going to be like a future classic of accounting and valuation. So yeah, thank you very much for being here in Value School.
Well, thank you very
Professor
much for your
Penman.
hospitality.
It's been great to have you.